Hello, everyone. This is Zak Gardezy. I'm the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and a private wealth advisor. So, on this week's episode of Money Minutes, I'd like to cover some of the latest market headlines and what my outlook is. So, a few of the headlines that I'll cover this week, one of those is all about the One Big Beautiful Bill. And I'll speak briefly about this, mainly because I'm releasing a second video, which goes into a lot more detail about this particular bill. But I'll talk high level about the impacts of this new legislation. I'll also talk about the tariff deadline. So there was a 90-day suspension of higher level tariffs on most countries, and that's expiring soon. So I'll talk about what's coming up ahead there. And then lastly, I'll be focusing on the recent jobs report for the month of June and what this means for the Federal Reserve and lowering interest rates. So let's get right into it. So, the One Big Beautiful Bill was signed into law on the 4th of July. Now, this particular legislation, which is a key landmark legislation, focused a lot on taxes, but a lot of other key areas, made some big changes to the overall tax system for consumers, business owners, everyday Americans, and even those that are in the ultra high net worth category. As I mentioned, I'll be releasing a video that goes into a lot more detail about this, but at a very high level, it maintains a lot of the elements of the Tax Cuts and Jobs Act from 2017, such as lower tax brackets, higher standard deductions. So if this law were to have not passed, you would have seen higher taxes for millions of individuals. Now, there's also some other key benefits, such as newer tax credits, enhanced deductions for things like tip and overtime income, auto loan interest, bringing back 100% bonus depreciation. So, and then even increasing the estate tax exemption limits. So, there's a lot of changes in this new legislation, but overall, it's going to bring down taxes for a lot of people. And again, I talk about this more in detail in my video, which I'll link in the description of this particular video. So, good news on that front, and it should have a stimulating effect to the overall economy over the next few years. So, if we go back to April, when it was Liberation Day, significant tariffs were placed on countries all around the world. And shortly after, the Trump administration, under significant pressure, the stock market was going down, the bond market was struggling. I'm sure many special interests and mega donors were calling in and saying, look, you've got to put a stop to this. They put a 90-day pause in place. Now, the goal was to try and get all sorts of deals signed during that 90-day period. Well, that 90-day period is expiring soon. Actually, Tuesday, July 8th is the last day that countries have, based on the current 90-day pause, to negotiate a deal. Seems pretty unlikely that we're going to have deals put into place by Tuesday. And so you can make the assumption that all sorts of these, high tariffs are going to get put into place. Japan apparently has not been negotiating very well with the United States, so the Trump administration has threatened even higher tariffs than previously stated on Japan. So this is coming up. We'll see it early next week. The stock market is likely to have significant volatility from this event. Now, what happens afterwards? Who knows? It's likely that another 90-day pause can be put into place, or maybe there could be discussions around, top trading partners get extensions and others don't. It's very unclear at this point. And whenever there's this lack of, certainty, there's going to be some higher volatility next week, in my opinion. So that's something to pay very close attention to because this is coming up just a few days. So the June jobs report is out, and it was shocking. There was a lot more jobs added than what was expected, and that is not a good thing if you're trying to project interest rate cuts, right? If you're someone who is bullish on the fact that we're going to get cuts this year, or three cuts, or two cuts, or whatever that number is, a strong jobs report goes against that theory, mainly because the Federal Reserve is basically taking this position now that because of tariffs, they're not sure what amount of inflation is about to, inflict upon the economy. So the only reason why, basically at this point, that they would lower rates is if the economy shows some serious signs of slowing down. Well, adding more jobs than expected is the opposite of the economy slowing down. And so this doesn't help the case of getting interest rate cuts. So basically, what we're looking at now is that the July interest rate cut is completely off the table. And the next cut, which is supposed to be, well, the first cut was supposed to be projected in September, Although the CME Fed Watch tool is still projecting a September cut, the probability of that has dropped significantly from just a week ago. And so the odds of getting three rate cuts is a lot weaker today than it was before this report was released. And again, this information is changing all the time. We may get an inflation report or another jobs report or something that shows the economy slowing down, and then the probability goes up. This is where there's going to be a lot of pressure on the Federal Reserve, whether it's in July or September. They have to make a decision. Are they going to keep rates where they're at and potentially risk slowing the economy even further and being behind the ball here? Or will they lower rates to try and get ahead of the slowing economy, but accidentally cause additional inflation while potentially tariffs creep in and cause additional inflation? And in the earlier segment, when I talked about the 90-day pause that's ending, right, which will ultimately lead to higher tariffs and potentially higher inflation across the economy, this makes the Federal Reserve's calculation even more complicated. If the Trump administration came out and said, look, we're not going to charge these significant tariffs, maybe we'll hit everybody with a 10% baseline tariff, and that's better than before, right? That's a lot easier for the Fed to calculate and figure out where the inflation rate will eventually be or what they project. But with all these different, if you remember that really complicated chart that was sent out and, had all these different high tariff rates for countries, then you got different collection rates and exclusions and different products that are going to be tariffed and some that aren't. It's very hard for the Federal Reserve to try and figure out what exactly will happen with inflation. So they'll just wait and see. That's the approach that they're taking. But you can only do that for so long, because if you wait and see for too long, the higher interest rates that we have, I mean, if you look at mortgage rates today, which are some of the highest levels we've seen in a very long time, it's really slowing down the housing market. Commercial real estate is being hurt, in certain areas with these higher interest rates. Small business formation. I mean, these higher rates are doing their job. They are slowing down the economy. But for how long is that appropriate? And is cutting too soon going to ignite a new, really difficult battle with inflation, one that we're getting pretty under control at this point? So we'll have to see. Nonetheless, this recent jobs report makes the Federal Reserve's job even harder. And I think if we get more reports like this, we'll have to have a different outlook as it relates to lower interest rates and the impacts that could have on stock market valuations. But nonetheless, this is a key jobs report that came out and something that all investors should be paying very close attention to as more information develops. So thank you so much for tuning into this week's episode. And if you have any questions, as always, please feel free to reach out.